Hello, I'm Brian Rezny, President of Rezny Wealth Management. We're going to have a great show for you this morning. One of the things that I want to talk about is not only market conditions, but investment behavior. We're going to talk about that in just a second. But before I start my normal part of my program, I want to talk about what we're seeing out in the U.S. economy. We're seeing improvement. And now I realize we've seen some volatility this year, and some investors become more emotional investors. They don't know when to sell. So I'm going to cover some of that today, so hopefully we can fix some of your bad investing behaviors. But with that, the economy is doing pretty darn good. We're seeing the job market slowly improving. We're seeing earnings on corporations actually coming in pretty strong. And we're seeing sales of those companies, which ultimately drive earnings, also pretty darn good. Sore spot in the economy, or the world, I should say, is Ebola. Of course, people get nervous. One of the things that you want to take a look at as an investor is, of course, Europe. I would say avoid Europe at all costs. We haven't been in Europe. I couldn't even tell you how many years ago it's been. Europe's a slow growth economy. It hasn't done well for decades. I would avoid Europe. Investments in the equity-based market, like the U.S., investments often correlate. So what I would say is this: you want to be in countries invested specifically that have earnings growth or GDP growth. Emerging market economies fit that bill. Emerging market economies are growing about twice as fast their GDP growth than what we're seeing here in the U.S. Of course, the U.S. is growing GDP, and that usually will translate into revenue and earnings growth. So the U.S. and the emerging markets, just kind of an overall, if you're looking for growth potential, generally speaking, at least on the earnings front, are relatively strong. As of late, we've had some weakness. We've had a little bit of pullbacks. But again, if you are a longer-term investor, and I talk about this all the time, I don't care if you're 20, 30, 60, or 70, you're a long-term investor. If you're 70 years old and you're married, there is probably about a 90% likelihood that one of you will live into your 90s. That's 20 years you need to live on your money. So again, don't hide under a rock. Manage the risk of your portfolio properly by having an adaptive investment strategy. With that said, let's talk about the 5 major traits that really affect you, the investor, and how you make less money and how you take more risk. And we want to solve this problem. So if you realize this, you'll make better investment decisions. You'll buy low and you'll sell high instead of selling low and buying high. The first problem that you and the investor faces is this. It's called the disposition effect. The disposition effect is the tendency for investors to hold losing investments too long. Let me explain. You go out and buy a company, let's call it Enron. You probably heard of Enron, one of the biggest bankruptcies in corporate history. So you go out and buy Enron stock because you liked it. Maybe not a lot of research, but you liked it because the stock price was going up. So let's say you bought Enron at 60, and then Enron drops to $50 a share. Well, you're not going to sell it at 50 because you've lost money. You'll wait till it gets back. Then it drops to 40. Well, you can't sell now because, again, you're even down further. Then it drops to 30, 20. Finally, it drops down to $1 a share. You've had enough, and then you sell. That's the disposition effect. Too many investors buy investments because they've heard of them without any real research, and they don't know when to sell because they really only bought the investment because it was Apple Computer or it was Enron at the time, which was the hot stock then. Whatever the investment is of choice that's going up today, investors like to buy. Then when they start to go down, they don't know when to sell, and they won't sell because they've lost some money. I'd rather sell and lose a little bit than lose my whole investment. That's real money management. The next problem investors face is focusing on past performance of mutual funds and ignoring the fees. This is a big one. A lot of investors will look at, let's say, a bond mutual fund. And they'll look at that bond mutual fund and say, boy, that thing did pretty good. It averaged, let's just use a number, 6% returns every year for the last 10 years. But they don't understand why that bond mutual fund made 6% every single year. Was it because interest rates came down the last 15, 20 years and they're at an all-time low? They don't realize that's why it made 6%. So with interest rates going down to all-time lows, what happens to that same bond mutual fund when rates start moving up? Those bonds go down in value. So what I would tell you is this, and bond mutual funds and bonds in general are a great example of this for the investor. The next decade, as rates either stay low or if they do move higher, the investor in a bond or bond mutual fund is going to make substantially less than the 6% that bond mutual fund made the decade before, because you can't make growth and total return on bonds when rates are already at the bottom. When rates move up, bond values go down. So again, don't buy on past performance unless the reason for that performance can continue because the fundamentals and the dynamics of that are still in place. Don't buy on past performance unless you understand how the performance was made and if it can continue. The other bad trait of investing is the familiarity bias. This refers to the tendency of investors to favor investments from their own countries. Great example of this. If I look at portfolios, by the way, I've been managing money for 28 years. 28 years I've been managing money for people just like you. I have literally talked to thousands of investors and reviewed thousands of portfolios over that time frame. And I can tell you this, if I have a client come into my office, whether they're 30 or whether they're 80, and I look at their brokerage statements they have, 99% of the time, their money is invested almost exclusively in the U.S., and usually stock or bond-related, U.S. stock bond-related mutual funds or stocks, and or U.S. bonds or bond-related mutual funds in the U.S. They never venture anywhere else, even though there's all these other great asset categories that may be potentials for your portfolio. So their toolbox is really small. The problem with that, you'll leave a lot of money on the table or potential money on the table. Look at all asset categories, not just stocks, not just bonds, and not just in the U.S. There's times where you don't want to own U.S. bonds, but emerging market bonds might be much better payers and actually much safer. So again, spread your wings. Having a toolbox with two tools doesn't make a lot of sense. I'd rather have a big toolbox and utilize the tools in our client portfolios that are appropriate today. The other problem that investors face is called naive diversification. Too many investments that are essentially the same asset. Let me explain. Just in the last couple weeks, I had a few new clients that hired my firm, came from the big brokerage houses. Both of these accounts were from a big name brokerage house, discount brokerage firm, that basically had 30 plus mutual funds in $1 million account. There was mutual funds and actual ETFs, and they were divided about 50-50. What was interesting, the person was generally a growth investor. So he had basically 30 investments that all owned pretty much all the same stocks, small and mid cap, but he had 30 different pieces in the pie. Some of them were better than others, but basically, why would you own 30 of the exact same kind of style mutual fund? You're not getting any more diversification. What you're doing is racking up more fees, and you're basically watering down the better funds or the better investments with the more mediocre. Put it this way. If you over-diversify, it would be like eating a turkey sandwich with 8 slices of bread on one side, a little turkey, and 8 more slices of bread. You want to properly diversify, and owning 30 mutual funds or 30 of the same ETFs in your portfolio, if your portfolio statement looks like that failed pie that I often warn investors about, you know, the pie that has 30 investments and some are going up, some are going down, but the portfolio never seems to really gain any traction, you've got the problem of too many assets that are not going in the right direction. That's not good for your portfolio, and it's not good for your retirement. Another bad trait, noise trading. Let's talk about this. Emotional investing based upon the news. By the way, Ebola, Russia, China, the U.S., earnings, the world's falling apart. We're all of a sudden becoming the Walking Dead TV show in the U.S. Not going to happen with Ebola. At the end of the day, news is going to drive bad investment decisions for you. I repeatedly urge and warn investors not to listen to news services where they basically are always talking about negativity. It's like I hear these stories on some of the big financial shows. Dow drops 300 points. That's a little over 1%, folks. If you can't handle bumps in the road, but the way they make it sound is it's catastrophic and the world just came to an end. Like you just lost 30% of your portfolio. But investors listen to this stuff. And by the way, not only is it news, but it's email alerts and all this craziness. News creates bad investment decisions and makes you trade more, which by the way, is great for Wall Street, discount brokers, banks, and insurance companies, but bad for your portfolio. At Rezny Wealth Management, we don't use any of that noise or news in our investment decisions. We use hard facts and research, which in our opinion helps our clients achieve a better successful retirement. I want to go to the phone lines and email questions. If you have a question about your portfolio, if you want to send me an email question, send it to Brian Rezny at reznywealth.com. I also encourage you to visit our website, reznywealth.com. You can also click a box there and send me a question for our next TV or even my radio show. And you can learn more about my firm and also sign up for a consultation to meet me or my staff so we can help you achieve your goals of a successful retirement. Andrew in Fort Myers, Florida. I only have $150K to invest and I can't afford to lose it. I'm investing in high-yield preferred stocks. Does that make sense in my situation? Andrew, that's a great question. First off, you told me you can't afford to lose it. The problem with preferred stocks is they're very similar to long-term bonds. So what's going to happen is this. If you're all in individual preferred stocks, you could lose a whole bunch of money. Preferred stocks will go down in value when interest rates go up. Interest rates are all-time lows. Most preferreds are kind of like a 30-year bond. You have a ton of risk in your portfolio. While the dividend that you're receiving from those preferreds looks pretty good, you could easily lose a huge chunk, 30, 40, 50% of your portfolio, if in fact either a recession happens in the next year, 2 or 3, weak corporate earnings, or if interest rates slowly move up 1 percentage point a year. You could lose a lot of money in preferred, so you're not playing it safe. You're actually taking a boatload of risk in your portfolio. I think you need serious financial help. I would suggest you call my firm for a consultation. As we always tell investors, there is a difference. We'd like you to experience it. Schmidt in Bonita Springs, Florida. What is your opinion of municipal bond closed-end funds? They took a small hit last week. These yields, the yields on these CFs are reasonable. Generally speaking, I like to avoid closed-end bond funds. Couple reasons. People buy closed-end bond funds typically don't understand and haven't done enough research. That's number one. Also, they buy these closed-end funds because the dividend stream they get usually looks pretty high. 6, 7, 8% sometimes. A lot of that dividend or that interest payment you're getting could actually be return of capital, your own money. And a lot of these closed-end funds do that. Also, a lot of closed-end funds, especially on the bond side, deploy leverage to jack up that interest payment. Margin and borrowing money, leverage, creates more risk in your portfolio. I do not like most closed-end mutual funds. If we do put one in our client portfolios, it's done because of a lot of research. And again, avoid leveraged closed-end funds. They are far too risky for the average investor, and you will probably lose a lot more than you ever gain from that extra interest payment that actually may be a return of money of your own. I'm going to take a short break in a minute. I want to leave you with this before we go to a break. Look at your portfolio statements. How have you done over the last 2, 3, or 4 years? Are the decisions that you're making timely? Do you follow a disciplined strategy which includes adaptive management of your portfolio, adapting to changing market conditions, and do you know when to sell? Do you have parameters in place, a sell strategy on when you're going to sell that losing stock, that bond, or a underperforming mutual fund? Do you have an investment strategy? Do you follow it? Or do emotions most often dictate your investment decisions? If that's the case, your returns are probably fairly poor, you're taking more risk than you know, and the next recession or market correction is going to hurt you a lot more probably than the average person. I'm going to go to a quick break. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. Hello, we're back. This is the Rezny Wealth Report. Of course, we're here every Sunday morning. Make sure you tune in every week. We always have great new information. If you have a question about your portfolio, if you're concerned about the advice you're getting, send me an email question to brianrezny@reznywealth.com. You can also visit my website, reznywealth.com. Call my firm for a consultation. We do have offices throughout Florida. If you're unhappy with the advice you're getting, if it's not timely, if it's not correct, if you're not getting the service you deserve, call my firm for a consultation. There's a big difference in firms. We'd like you to experience the benefit of working with a real money manager who's looking out for your best interest. Eleanor, Marco Island, Florida. I would like to put my husband's IRA and my IRA into the best dividend-paying stocks and use the dividends. What do you think? Great question. Don't do it. First off, it sounds like you're retired and you need money. So you're going to take your husband and your IRA and put it in a group of dividend-paying stocks. How are you going to pick those stocks? Are you able to research those stocks? Sure, I could give you 5 or 10 great stocks right now, in my opinion, that you should own now. But what happens when you shouldn't own one of those stocks a month from now or 6 years from now? I always encourage investors, don't buy individual stocks. Look at ETFs, exchange-traded funds. You'll be better diversified. You won't have to do the heavy lifting of a lot of daily research with individual stocks, and you'll have less risk and volatility if you have a better diversified portfolio. What you should do if you're looking for income, hire a real professional firm that can provide you total return, the opportunity for growth and income. We do that every day, and we've done it every day for 28 years at my firm. Pam in Miami, Florida. What do you think of Apple split? Is it a buy? Are splits good for stocks? Pam, we get a lot of calls and questions, not only my TV show, but my radio show, about stock splits. First off, stock splits are neither good nor bad. If you look at long-term studies on stock splits, it doesn't mean just because a company splits, the stock always goes up. In fact, a lot of times a stock can go down. What drives a stock price is simple. Earnings. If earnings grow, there's a good likelihood that the stock price will go up. Apple Computer, I think, is a very good company. I think they're a very mature company. I think if you do your research and you like the growth potential, PE ratio, price to earnings, and a lot of the metrics we would look at, I think Apple's an opportunity. But remember this, you have to know when to sell. Apple, like any stock, is not going to be a buy and hold and tuck it in the pocket for the next 5, 10, 15, 20 years. There could be a point 3 years from now, as an example, where you're going to need to sell Apple because competition's big, they're eating their lunch, they're taking away business, and Apple stock collapses. So again, never buy and hold any investment. Buy, research, continue to research, and know and have a sell discipline before you buy that stock. Stocks require a lot of hard work. Most people don't have the time or the talent to buy individual stocks. Stick with ETFs, exchange-traded funds. I think you're going to be much better off that way. Bill from Naples, Florida. With the market trading at close to new highs, should I be selling? Bill, this is what I would tell you. Just because the market's at a new high now, or was at a new high last month, or 3 years ago, isn't a reason to sell. Think about this. Just because something's at a new high is something fundamentally changed where it should magically go down 30 or 40%. We're not seeing that. What's going to drive equity prices higher to that new high is going to be earnings and revenue. If earnings grow, revenue, and so on, typically equity prices go up along with it. So just because something's high doesn't mean it can't go higher. But remember this, nothing goes up in a straight line. What's healthy for stocks, bonds, gold, all asset categories is a stair-step pattern. You go up 3 flights of stairs, you go down 1 or 2. You go up 4 or 5, you come down 1 or 2. You need that. Anything that goes straight up and it looks like a pyramid, that usually are your riskier stocks, and those are things that I would want to avoid because usually the valuations are stretched and all the momentum players and risky people are involved, and usually that's when the small guy gets involved at exactly the wrong time. Roger from Fort Myers, Florida. What if my company's 401k plan is lousy? What should I do? Roger, your problem with your 401k plan is the same problem almost every investor has. Most 401k plans are generally lousy. They have limited options, usually 10 options to pick from. Sometimes the expenses are high, but I will tell you this. You are on your own picking your own allocation and building your own strategy on your 401k plan. Don't think the rep who handles the account for the company is actually looking out for you. They can tell you about the funds, but you're not under an investment advisory contract most of the time in most 401k plans. So the rep is a broker selling you to get in the plan. So realize that. So if you are in a 401k plan, what I would suggest you do, set up a set of principles. Are you trying to grow the money or preserve the money? Most people that are in 401k plans are trying to grow the money. So generally speaking, look at small mid-cap in the U.S. If you have emerging market opportunity in your 401k plan, maybe do a 25% across the board if you're a growth investor. What you want to do then is reduce that equity exposure when the economy is showing signs of actual weakness, unemployment starts going up, and corporate earnings drop. Those are good signs of a next recession, and you want to avoid at least the major part of a down draw. This way, you're staying away from a lot of trading, and you're looking for long-term growth with mild bumps in the road. Mary from Cape Coral Gables, Florida. I own 4 variable annuities, 2 from Allianz and 2 are IRAs, and the other 2 are individuals. My advisor is recommending I transfer them into an equity index annuity with security benefit and Aviva. What do you think? Don't do it. Bottom line is this: you should have never bought an annuity in the first place. Go to my website for more information, ReznyWealth.com. Download our free report, Why Annuities Are Dangerous to Your Wealth and Dangerous to Your Retirement. Now let me tell you what's happening. You already were sold an annuity. Chances are you probably want to get out of that annuity and get into a much cheaper account. The average annuity, especially variables, the ones that we've reviewed have annual expense ratios that come against your returns, often approaching 3, 4, 5% every year. Crazy expenses. Brokers and annuity salespeople love selling annuities because of the commissions. Those commissions are not good for you, they're good for them. Annuities are dangerous, they're expensive, and they rob your return. What your current salesperson, which is all he or she is they're trying to unload one annuity and put you in another annuity to get another gigantic commission, and all you're going to do is insanely lock your money up with another surrender penalty that could be 8, 10, 12 years long to get all your money out. That is crazy. Fire that guy, find a real fee-only investment advisor firm. I would suggest you call my firm. We can review all those annuities and tell you exactly what you're up against, and we can help build a proper plan that can help benefit you and not the annuity salesperson. Joan in Fort Lauderdale, Florida. Can you explain the difference between fiduciary versus suitability? Great question, and I wish I had more of those questions. Let me explain. About 90% of firms nationally are fee-only fiduciary registered investment advisory firms. About 10% are fee only. 90% on the other hand are commission or fee based. So again, nationally about 10% of firms are fee only registered investment advisory firms. That means the other 90%, Wall Street companies, banks and insurance companies, are typically fee based and commission. Okay? Most of those firms work under suitability. If you're working in a brokerage account under suitability, suitability means they only have to sell you investments you're suitable to buy based upon age and goals and objectives. They can be the lousiest return investments, the most expensive, and suitability has been met. Under fiduciary, a firm like Rezny Wealth Management, and we're a fee-only firm, by the way, we have to legally work in your best interest and only provide advice that's legally best for you, not what's good for us. So your broker at Wall Street, your broker at the bank, your so-called advisor, the person selling annuities is often working under suitability. Their goals are different than you. Their alliances to their firm and their firm's alliances to themselves and not you. So what I would suggest you do is go to my website, ReznyWealth.com. If you want to learn more about fiduciary versus suitability, download our free report. It's called Your #1 Investment in Retirement Risk. It's at the bottom of our homepage. It's also titled Fiduciary versus Suitability. It's a simple questionnaire. You'll get your questions answered. It'll talk about what the differences are. Suitability will rob your returns in high cost, risk, and non-management in our opinion. Watch out for people who are working under suitability. You want a fiduciary advisor only, and if somebody will not sign off as a fee-only fiduciary, and remember, fee-based is not fee-only, it's not remotely close. Rob in Miami, Florida. Gold, silver, and gold stocks have taken a beating in the last 3 years. With these rock bottom prices, is now the time to invest. No, gold and silver have been relatively weak. Never buy into a relatively weak sector. Gold is supposed to go up. Why? Because of geopolitical events. Well, we've got a lot of things going on with ISIS, Russia, Crimea, the Ebola virus, and what has happened to gold prices? They've dropped like a rock. I would avoid gold. Usually gold will also go up if we have high inflation. Well, guess what, folks? We have low inflation. Gold should be avoided. If you own gold, I would sell it and take a tax loss. I'll leave you with this on gold. Never buy gold from a gold commercial. Never buy rare gold coins from a gold commercial. These are big rip-offs with huge markups, often approaching 20% to buy gold, and I've seen markups as 600–700% to buy gold coins. Never buy through a commercial. If you really like gold and it fits into your strategy, look at an ETF symbol GLD. It owns physical gold, stored in a warehouse, very cheap, and a cheap annual expense ratio. That's the best way if you feel gold's good for you, but I'm telling you right now, gold's in a downtrend, relatively weak, and it should be avoided currently. You know, I'm close to out of time. As I always stress, bad investment advice doesn't fix itself. Call us for professional advice. Make sure you take a look at your broker statements, folks. Do you have the failed pie? Is it set it and forget it? Is the advice you're getting excellent? You deserve great financial advice and excellent service. Let my firm help you achieve a successful retirement. If the investment advice you are currently receiving is lackluster, if your service is awful, if your broker is more interested in themselves than your portfolio, call us. We would like to help you get your portfolio back on track. Too often, too many investors don't do the right things with their money because they're using the wrong firm. Only hire a fee-only fiduciary firm. Go to my website, reznywealth.com. Call us for a consultation. There is a difference. We invite you to experience it. Make sure you have yourself a safe and profitable day.